Hello everyone, I hope you are in a good shape and welcome back to our semesters online, of course. And here are several things that I want to talk with you a little bit before we get started on this chapter 14 actually. First thing is that I told you that I'll try to post the videos on our Skidmore cloud, but actually when I tried this, when I tried that and I found out that the video resolution is very low, that's probably gonna hurt your eyes if you keep watching those video clips. Alright, so I will stick with YouTube. If you have hard time to access YouTube, please let me know. I definitely can send you another link, okay? And to some, I'll try to post our videos on different websites, so that way if you have if you don't have access to that specific website, I can give you the link, the access to other websites. Okay, so make sure that you have the materials that you need to finish this course. All right, so second thing is about our final projects. The final projects, as I said in the last email, that you could either do a individual project or do a group project, right? So what I want you to do now in this week is to think about whether you want to do individual or want to do a group project. Okay, so if you want to do a group project, please start to contact your classmates. I list out your email address in our discussion forum, so you can get in touch with your classmates and to see if you can form a group. All right. If you want to do a individual project, that is fine as well. But what I need is by the end of this week, I want you both either send me your group with your group members, or if you want to do an individual project, please send an email to me says that you prefer or you decided to do an individual project. That way I can put your email address down from our contact list in the discussion forum. All right, so make sure you start to form your group. All right, and I'll try to post our final project cases on Blackboard. Hopefully I can have that done by the end of this week, and then you can start to pick your project for your final. All right, okay, so now let's get back to our real business, the lecture. Okay. Alright, chapter 14. So in this chapter, we're going to talk about cost allocation, customer profitability analysis, and sales variance analysis. And basically, the core of this chapter is this customer profitability analysis. So basically, in this chapter, we're going to learn the materials, the concepts to analyze the customer's profitability. All right, and all these things will be used and contributed to this customer profitability analysis. All right, so here is our learning objectives. All right, so you can look at this, and customer profitability analysis, also it's we have another management technique called customer profitability management, and basically these two are the same thing. All right, so the goal of using this sort of technique or management strategies is to improve companies' profitability from measuring and managing customers or customer segment profitabilities. All right, so what it's saying here is that the underlying goal is that a lot of managers or a lot of companies really they don't have a clue about what is the secret to improve companies' profitability. And here a lot of companies actually they don't know that customer profitability analysis could help companies to specify their target market and to increase their profitability. All right, and the reason is that probably if you look at your profits by customers, and you figure out that the profits earned from different customers, it varies. All right, it varies. Okay, and given the bargain power on the market between you and the customers, and given your sales team's negotiation capabilities, skills, and also given the market conditions, and also something like business life cycle. Okay, so you're probably going to end up with different a variety of profit portfolios from your customers. All right, so then to have a better understanding of the company's profitability, and then in order to implement some strategies to improve company's profitability in the future. So customer profitability management is a kind of an effective skills. Okay, so I believe everyone have heard about this 80-20 rule. Okay, the Pareto principle. Okay, so basically what it's saying is that if we 20% of the effort we spend is to can result in the 80% of the outcomes, right? And if we apply this rule to business model, it's kind of like that. Okay, so basically is the top 20% of our clients may contribute to 80% of our profits. Okay, to our profits, and this is generally principles applies to everywhere, right? So basically we spend 20% of our time to deal with 80% of to contribute to 80% of our work, or so to speak. All right, so but if we are using customer profitability analysis, this management skills, and a lot of time that the results really surprise those managers. And the reason is that when we look at those profitabilities by customer or by customer segments, and we realize that more than likely or most of the time that we can see 20% or roughly 20% of our customers actually contributed to more than 100% of our profits. Okay, I probably you think, why could so much percentage of customers could contribute more than actually what we earned, right? So hold that question. We're going to explain that in the later chapters today. All right, so basically if we look at profits by customers or by customer segments, and we can realize that actually we can do better than the 80-20 rules. That means we can earn actually a lot more than we are earning now. Okay, so so customer revenue analysis, it is one element under the customer profitability analysis. Okay, so customer profitability analysis, basically we're looking at how profitable a specific customer is. So in order to have customers profit information, we have to have at least two pieces of information, right? So that first is revenue, and second is cost, right? So because revenue minus cost is profits, right? So if we want to look at customers profitability, then we have to look at these two elements separately. Okay, revenues and costs. Okay, so this CPM is customer profitability management system. Okay, so a CPM system assigns net revenue to each customer or customer segments. And here, remember, it's keep that in mind. It says net revenues, because when we talk about revenues, we have gross revenues, and when customers purchase products or service from us, and more than likely we're going to offer some discounts to attract more customers, or if when the customers receive the products and they are not satisfied with those products, they probably gonna return some of those products, right? So we have some return to deal with, right? Or we have we're probably gonna offer some allowances for defective units, right? So we cannot use gross revenues, because gross revenues is really not telling an accurate picture of of the sales performance. All right, so we have to use net revenue, which is more clear and more accurate information about customers' revenues. All right, so and there are actually two variables in general can explain the revenue differences across customers. Okay, first is the number of products purchased. The second is the magnitude of price discounting. Okay, so that's the discount offers to the customers. Okay, so the number of products purchased, because different customers could buy different amount of products from us. If you're a small business, you're probably gonna buy like a very small batch, and if you're large wholesalers like Best Buy, excuse me, it's not a wholesaler. Large grocery stores like Walmart and Target and Publix, Kroger's, and those type of business, they're probably going to purchase a lot products from us, right? So that could cause a different revenues and a different earnings at the end of the day, right? And the second element is the magnitude of price discounting, right? So remember when in 235, when we talk about price variances and materials variances and labor variances, those kind of variances, and we're trying to analyze what causes those variances, right? So a similar idea here, that if we purchase more, if a customer purchase more, we're probably going to offer a larger discount to them to benefit them, or actually at least to incentivize them to retain with our business, right? So these are the two general factors that could explain revenue differences from customer to customer. All right, so basically this is a very simple idea about revenue differences. Okay, so another factor here that explain the customer profitability differences is the cost, right? Customer cost analysis. So actually, customer cost analysis is a lot more complicated than the revenue difference analysis. Okay, customer revenue analysis, because revenue is really has so few elements that we can talk about, that we can look at. But when it comes to costs, as you already know, that we have so many different types of costs. We have direct costs, we have indirect costs, we have relevant costs, we have irrelevant costs, we have manufacturing costs, we have period costs, and so on and so forth, right? So we have so many different costs, and some of them are really intuitive, and some of them are really pure arbitrary. Okay, so it depends on how we treat and how we define those costs. We're probably going to end up with different cost for a unit of product. So that really is a critical piece of information in terms of determining customers' profitability. Okay, so assigning costs to customers is the backbone of the CPM system. If we're not able to provide an accurate cost information for each customers, then we are not able to arrive at an accurate profitability conclusions, right? So then later on, we are not able to provide or implement an effective or efficient strategies in order to improve our overall profitabilities. That makes sense? So customer cost analysis, and we classify cost at several different hierarchies, and that are introduced in chapter 5, the activity-based costing chapter already, and we'll follow along that chapter's cost classifications. All right, so I'm not gonna extend on this topic. So if you have any questions about this specific cost classification, please go back to chapter 5 to review those 5 cost categories. All right. So first is customer output unit level costs, and it's really the cost based off on the each unit produced, okay, assigned to the unit produced. And then second is the batch level cost, customer batch level cost, and it's cost per customer order, for example, or per delivery. Okay, so the cost of processing purchase orders, the cost of processing sales orders, and the cost to deliver that order to customers, because customers probably gonna they are located in different locations, okay, and different states and different countries, and the shipping cost is different, and the insurance cost is different, and so on and so forth, okay. And the third one is the customer sustaining costs. Is the cost to support individual customers regardless of number of units or batches. So it really is not about the number of units you produced and provided to this specific customer. It's not really the order that you produced, you processed, and ship it off to your customers. It's really about your customer relationship, okay? How you retain your customers, how you satisfy your customers from some other ways, okay? So this is another type of cost to retain your customers. And of course, if you, for example, if you buy like you buy a purse every month from Louis Vuitton, then probably you are the VIP customer to LV, right? And I just happen to buy one of their products on sale, like in the 20 years of my life, okay, or 30 years of my life, and then they're probably going to treat you differently, from me, how they treat me, right? So that makes sense, because you are more profitable to them than I am, okay? And the fourth one is distribution channel costs. It's not about a specific customer. It's not about the sales orders. It's not about the cost to produce the products. It's not about to maintain our customers, to make them happy. It's really about how we distribute our products, okay? It's about supply chain management, right? So how do we deliver those products, okay? So these costs are really, in general, is a indirect cost, or let's say some companies can classify this cost as a period cost, right? So it's probably not something that we can assign to the specific customers sometime, okay, not in general, all right. And the last one is division sustaining costs. It's the cost that cannot be traced to a product, customer, or even a distribution channel, all right. And an example would be the division manager's salaries, okay. So it's similar to the headquarters expenses, like depreciations, insurance, and amortizations, and salaries of top management teams, and advertisement costs, and utilities, and those kind of costs, all right? So those are not really related to, or they're far away from any activity, production activity or customer relation activities, okay? So this is not, this cost classification is in our textbook, but really when we look at the cost classification here, we can break these 5 cost classifications into 2 general sections, okay? 2 general sections. First is product cost, the manufacturing cost, which really makes sense, right? It's the cost of making the products, right? So it's just probably the unit cost. Here we have direct materials, direct labors, and manufacturing overhead costs, right? And the other 4 costs is cost to serve. The cost to serve a specific customer, okay? The cost to serve a specific customer. Probably when we look at these 2 general different costs, we realize that the cost per unit from customer to customer didn't really change very much. That makes sense? You spend $10 materials on 1 unit of product that ordered by customer A. Probably you're gonna spend the same amount of materials into the products ordered by customer B. Okay, so it's pretty much the product cost is less sensitive, but the other 4 costs, the customer batch level costs, customer sustaining costs, and distribution channel costs, and division sustaining costs, all these, the other 4 different costs, we call it in total, we call it cost to serve. It could vary from customer to customer, right? So the amount of time you spend with helping one of your customers, probably different from the time you spent to assist the other customer, okay? And the amount of resource that you contributed to earn revenues from specific customer probably going to be different from the other customer, okay? That makes sense? So this four actually worth a lot of attention when it comes to customer cost analysis or customer profitability analysis. All right. So if you look at these 5 cost classifications and you realize that it's very much similar to the cost classifications in Chapter 5, the activity-based costing. And in that activity-based costing, really, we look at those 5 different levels company-wide, right? Company-wide cost classification. But here, we're trying to break all those costs by customers. Okay, still we're gonna have exactly the same 5 levels of costs, but now we're not really looking at those costs across a company. Okay, across company, we're looking at by customers. We want to separate all those costs by different by each customer. Okay, and to figure out how much is the cost to provide a service or to sell products to that specific customer, and then compare that with the revenue earned from that customer. Okay, that makes sense? All right, so here is an example that I pull out from the textbook. Okay, so here the division cost and cost driver information. Okay, we have activity area. Here we separate, or it's similar to activity-based costing, and we pull out a team and to figure out each different activities, and then what is the cost driver for each activity, and then we have the total cost for activities and total quantity of cost drivers. Okay, and then calculate allocation rate for each activity or activity rate, and then cost hierarchy category. Okay, so which cost category that these activities should belongs to. All right, belongs to. Okay, so it's very much similar. Actually, if we're looking at this calculation, the math process, it's 90% or 95% exactly the same as we did for activity-based costing. Okay, so then here quantity of cost drivers and select customers. Okay, then we have all these activities that we designed by the team. Okay, by the team, and then we have these cost drivers, the total units of cost drivers, activity level. Okay, the activity level, and we break all these. We break, for example, sales orders. We break all the total sales order cost drivers by our customers. Okay, so in this case, it only shows 4 customers, and then for this slide only, we assume we only have 4 customers. Okay, in this slides, we assume we only have 4 customers. So then, if we add these 4 numbers up, 2200, 1200, 1600, 300. If we add these up, is 3100 number of sales orders. Okay, so that'll be the total cost drivers here, total activity here. Okay, activity level. However, if we have more, then we're gonna extend this list and add more numbers into here. All right, but the idea here is that we have this total activity level, and then we allocate to, or we assign to each one of those individual customers. Okay, to each individual customers, and then here we have revenues at list price and price discount and revenue. So basically it's our net price. Okay, net price, and we have cost of goods sold, which really is, still we are using the absorption income statement, right? It's not a variable income statement. Okay, so we absorb every manufacturing cost, every piece of manufacturing cost into a product cost, which we have cost of goods sold. All right, and then we have gross margin from each different customers, and then we have all these different level of costs that we designed on the previous slides. Okay, and those costs are based off on the number of activities they required or they consumed by each different customers and multiplied by the activity rate. Okay, that makes sense. Okay, it's very much similar to as we did in activity-based costing. And then we come up with the total customer level costs. We have all these gross margins and all these separate costs, and then we assign to each customers. Then we are able to find the exactly, not really the 100% accurate, but sort of more accurate cost information for each customers, for each client. Okay, then we are able to find the customer operating income, and so to speak, it's really much like customer profitability. All right, and then we are able to see who is actually generating more profits than the others. That makes sense. So in this case, customer J, it's not customer J, customer B, that we earn the most profits from customer B than the other three. And actually from customer G, we're actually losing money. That makes sense? So in this case, using customer profitability management, we're able to see who is most profitable customers to us in terms of using resources and to promote revenues or promote sales activities. Okay, it's not really the customers with the highest or the largest revenue could grant into highest profitability. Okay, it doesn't make sense in that way, because still we have the other part of the information need to think of, which is cost part, right? So see here, in terms of revenues, really customer A, we earn much more revenues from customer A than from customer B. But at the end of the day, customer B provides higher profits to us than customer A. All right. So here, when we have this information list for each customer, and we're going to list the information in Excel spreadsheet or in your cost accounting information system of the company this way. Okay, we have customer level operating income, which is extracted from the previous Excel spreadsheet. Okay, and this is basically the profits earned from each customers. So here we have 10 customers. Okay, we have 10 customers, and customer B, we earn the most profits from customer B. Okay, so we list the customers in the profitability order, with the highest profitability on the top and the lowest profitability on the bottom. Okay, and here is customer revenue. So the second column here is the customer revenue, and the third column here it says customer level operating income divided by revenue. Okay, and that's really operating. It's the customer level operating leverage, right? The customer level operating leverage. Okay, and column 4 is cumulative customer level operating income. So here it's the cumulative operating income. That's for example, for customer B, the customer operating income is just $5,690,000, and when it's come to a cumulative, starting from the second customer, it's going to be the sum of customer B's profits and customer A's profits. Okay, so here the $10,605,000 is the sum of $4.9 million plus $5.6 million. Okay, that's the sum of these two numbers. This is a cumulative operating income up to customer A from the list. And here on this line here, the $13,260,000 is the cumulative operating income from customer B, A, and C. Okay, B, A, and C. So here we have this cumulative profits from the customers up to this point. Okay, up to this line. All right, and here all the way up to here is the total, and this number, the very bottom number, is our total profits earned from all of our customers. Okay, this is the total overall profits we earned from our all customers. Okay, so this is why we list out in this format, because really this one we convert that into a percentage figure. In column 5 is cumulative customer level operating income as a percentage of the total customer level operating income. So what I'm saying here is our total customer operating income is $15,027,500. This number comes from here, the total profits, and then we divide this column by the total, and to see up to this point how what's the proportion of our total profits has been earned up to this point, or up to this clients, up to this customer. Okay, so for example here we see customer B contribute to 38% of our overall profits, and to B and A, these two customers add up, these two contribute 71% of our overall profits, and the top 3 customers contribute to 88% of our overall profits, and the top 5, 1, 2, 3, 4, 5, up to customer F, we have earned 1.04 times of our profits. Okay, and the logic and the concept here, the cumulative percentage that really can help us to see from starting from which customer, starting from which specific customer, actually our profitability is decreasing. Another way of saying this is that which customer is really not profitable and which customer is actually we're losing money from them. Okay, so here is the list, and we can list all the individual customers' profits in this histogram chart, or this is a new down the bottom here. This is a new chart. It's called the CPM, Customer Profitability Management. It's a wheel curve. Okay, it's the wheel curve. Okay, so it's the wheel curve. Why is the wheel curve? It's because it shows you all the profitability here, and this is not really a good example showing the wheel curve, because the wheel curve have something else on the on here. Okay, so and let me show you another chart. Okay, let me show you another one. See if we have that wheel curve. So if you see this PDF, all right. Okay, so what wheel curve here is that this is the sea level. The sea level really is the total profits, and the cumulative profitability here shows how much more we have earned than the total profits up to this point. Okay, and we want to extend this curve, the peak, as wide as possible. Okay, as wide as possible. And here we show the wheel curve in terms of percentage. Okay, so then basically is the curve above the 100%, which is the sea level, and the wheel jump out of the water. Okay, jump out of water, and then this is the peak of the curve, and we want to extend this peak as much as possible. That way we can earn more profits. That makes sense? So in our slides here, it's not really easy to see, but still it's 100%. Okay, and we're slightly above that because from given information here, okay, the peak is 11% more than our total profit at the end of the day. Okay, so we want to extend the peak as much as possible. All right. So criteria to get cost allocation. All right. So since we have this analysis skills to help us to pinpoint the most profitable customers versus the least profitable customers, and the critical part here is how to allocate those costs. What techniques we use to allocate costs. Right, so because remember in activity-based costing, and those cost classification really is based off on, in general, based off on causal effect, right? Causal effect. If this activity really drives those costs incurred, then they should go into the same should go into the same activity cost pool, right? Here that is the first one, cause and effect. Use this criteria, managers identify the variables that cause resources to be consumed. And actually there are three more categories. Probably can see that from the background. The second one is benefits received. Okay, I don't really using this benefit criteria. We are trying to see is that, okay, a lot of companies that have so much complicated structures, and they are not able to easy to see the causal effect. But with that being said, they probably can know, I don't know who actually used this resource, but I know at the end of the day which department actually benefited from that resource or benefited from that activity. Then we just assign those costs to the department or to the segment or to the activities that benefited from the resource consumption. All right. And the third one is fairness or equity. All right. So this criteria is often set in government contracts when cost allocation are the basis for establishing a price satisfactory to the government and its suppliers. And for profit business, for profit organizations, or it's not really a widely used criteria, because fairness or equity is really subjective criteria, and it probably situations can come up like, okay, you think that is fair to your department, but I don't think that is fair to my department, right? So there's some conflicting areas. And last one is ability to bear. Okay, so this criteria advocates allocating cost in proportion to the cost object's ability to bear cost allocated to it. Okay, so if you are the department who is earning so much more profit revenues, then you can bear more costs than the others. But really, if we are using this criteria, they potentially could cause fairness issues, right? So that's kind of, these two are not really widely used, commonly used in business. But these two, one way or another, they're gonna be they are widely used. And causal effect is most common criteria that we use when it comes to cost activity designs. Okay. All right. So the causal effect, which is the most common criteria we use, and it's similar. It's a similar foundation for activity-based costing. But as remember, as we talk about activity-based costing, the advantage is that they can really provide accurate information and to promote efficient strategies but they have some drawbacks, right? The drawbacks is that they cost a lot of resource to set up activity-based costing systems, and they requires cooperations, and they have to getting the support from the whole company, right? All levels of people, right? Top management teams, all the way up to down to the frontline workers, right? So that is not really convenient to set up activity-based costing. However, here is a different form of or different type of activity-based costing. It's called a time-driven activity-based costing system. Again, it's still under activity-based costing system family, but it's a different, or it's a more easily and more convenient way of using activity-based costing. Okay, so the general idea about time-driven activity-based costing is that, okay, so each department probably use different amount of activities, different cost drivers, different activity levels, right? But each activity, at the end of the day, they consume one common resource, which is time, right? Time is a critical resource, which once you used up, and it will never resupply the time, right? You just 1 minute passed, and you cannot really get that the last minutes back. That makes sense? So that is very critical resource, and each activity, each department has to use this resource to accomplish their goals, to accomplish their activities, right? So now the general idea of behind time-driven activity-based costing is that, okay, since we are not able to classify such different type of activities, then we can quantify the total amount of time that will be consumed by each department, by each activity, or by each sections of the business. That makes sense? And then we have that practical resource capacity, right? So how do we calculate that? The answer is you have so many number of employees, and each employee work like 8 hours a day, 40 hours a week, and you know how much time they probably gonna work, and the total number of hours you're gonna have in terms of the company as a whole, right? Make sense? And then all these costs incurred, okay, you can divide by the total cost by the total time. You have a rate for per unit of time, okay, either per hour or per minute or per day, okay. So then based off on that, you assign those costs to, for example, activity department A it requires 8 hours to finish 1 unit of something, okay, and it's $10 per hour, okay. So your rate is gonna be $80. That makes sense? So we use that kind of thing to calculate activity-based costing. All right, so that is time-driven activity costing. All right, so time-driven activity-based costing concept calculate the cost of supplying resource capacity, and using the capacity cost rate assigns departmental cost to cost objects by estimating the demand for resource capacity, which is time in this case, that each cost object requires. Advantage avoids the costly, time-consuming, and subjective activity serving task of conventional activity-based costing, which is the traditional activity costing in Chapter 5. And weaknesses is simplified activity mapping process reduces the opportunities for activity analysis and activity-based management. But given the cost-benefit analysis, time-driven activity-based costing probably is going to benefit to more of the business than traditional or conventional activity-based costing system. All right. So here is an example that I pull off from the internet. Okay. So just give you an idea of how to use time-driven activity-based costing. So here we have different activities, 3 different activities, and activity level, and have different quantity here. And unit time is each unit of this activity requires 8 hours in this case, or let's say 8 minutes. Okay, so total minutes, total time used. Okay, total time used, and cost driver rate, which is per unit of this activity. Okay, so here total cost assigned is based off on the activities and the activity rate. And how do we get this activity rate? We have this total supplied resource, which is the total number of time we can spend on all of these activities, which is 700,000 minutes. Okay, and for spending that 700,000 minutes on within a certain period of time, it cost us in total $560,000. So then that way we get, so it's 80 cents per minute. 80 cents per minute. Okay, 80 cents per minute. And here, for example, process customer orders. The activity here is 51,000, probably 51,000 orders. Then each order takes 8 minutes. 8 minutes times 80 cents. Okay, 80 cents is per minute rate. Then 8 times 80 cents, it equals $6.40, which is cost driver rate. So for each unit processed here, it takes $6.40, and so true for these numbers, for these informations. Okay, in this way we can actually assign all of our costs, okay, all of our costs into different activities, or let's say different cost objects. That makes sense? Okay, so that way we have all these costs assigned to different activities, and then we can prorate these costs into each different customers, okay, and then come up with the customer profits analysis. Okay, and then using this information, the customer profitability analysis, using this information, we can actually integrate some strategies. Okay, so managers must explore ways to make unprofitable customers profitable. When doing so, they should include factors other than the current profitability level, and include the following factors. But before we moving forward, here's the thing that I want you to keep in mind. Okay, since we're doing customer profitability analysis, we're not only looking at those customers who is profitable, and we're also looking at the customers who is less profitable or who is generating loss. Okay, so basically in general there are 3 categories of customers in terms of customer profitability analysis. Okay, so I'll write it down on the slides. And first is called profitable customer. Second is called break-even customer, which we don't earn any profits from this customer. And the third one is loss customer. Okay, the customer generates loss. Okay, for selling products to them, we're losing money. All right, so there are generally 3 different categories to classify our customers in terms of profitability. First is profitable customer, second is break-even customer, third one is loss customer. All right, so these are the 3 different customers. All right, so and then what we're trying to do here is that we're not only looking at loss customers, we're also looking at the profitable customers and the break-even customers. And the idea here is that the profitable customers, first our VIP customers, right? Our VIP customers, okay? And those customers, and we're trying to figure out if there are some common features that they like, or if there are common features that generate profits for us from selling those products or providing services to those profitable customers. If that is the truth, then how we can apply or how we can sell those additional features to our loss customers or to our break-even customers. That makes sense? Or let's say if there are some specific unique features that granting more profits from one customers over the other customers, then how are we able to apply or offer that specific feature to a different profitable customers? So idea here is we are trying to improve our profits overall. Then we have to try to improve our profitability from each specific customer, not only profitable customer but also break-even customers and loss customers. That makes sense? All right, so now and what else we look at is for lost customers and break-even customers, these factors these factors apply to both. Okay, apply to both, and also applies to the profitable customers as well. All right. So let's look at these things. Likelihood of customer retention. Okay, so probably if it's profitable customers, and you probably gonna invest more resource to retaining your customers. Okay, so the reason is that theoretically speaking, it costs a lot more to obtain a new customer than to retain an existing customer. Okay, and the cost is about like 3 times more or 2 times more to obtain a new customer than to retain an existing customer. Okay, and the potential for sales growth. Okay, so if we're looking at profitable customers, what are some potential areas, what are some potential features we can offer to our profitable customers? And for break-even and losses customers is are those profitable features, or are those features that we offered to profitable customers can be applied or can be offered to those break-even and loss customers, so to speak. And then the third one, which in this discussion, I mean in this chapter, I think it's more important than any other factors, is this long-run customer profitability, which is known as customer lifetime value. Okay, it's known as customer lifetime value. It's very important concepts. Okay, it is very important concepts because this is the factor that a lot of people, a lot of managers actually, it's easy to overlook. It's easy to miss this important concepts. Okay, when they look at those customers' profitability, it's called customer lifetime value. Okay, CLV. All right, CLV, customer lifetime value. Okay, lifetime value is long-run customer profitability. What it's saying here is that if we're only looking at the profitability of a specific customer over a year or over 2 years, that really doesn't tell a very general idea about that specific clients. Okay, about that specific clients. If we're looking at a longer period of time, then it's probably going to tell us a more accurate information about that company, right? So how much accumulated profits we have earned from that customers. If we're looking at 1 year or 2 years, for example, this year probably some of the customers from us, we're not going to earn anything from the customers because about the pandemic outbreak, right? And most of us are self-quarantined at home, right? So it's not most of business already shut down, so we are not able to earn anything from our customers. But still, we probably gonna offer some support to our clients to maintain a good customer relationship that costs a lot more, right? So it is not a good point to using 1 year or 2 years, or let's say too short period of time to look at that thing. And another thing is, when we look at those, even if you're looking at one specific year performance of those customers, you have to realize that our customers probably, they are in the different stage of their business cycle or their life cycle, right? So some of our clients probably just a startup, okay, and it's our new clients filling this year, and some of them are really the mature big companies like Walmart, okay, or Costco. All right, so those kind of companies. Okay, so probably, and more than likely they're gonna order different amount of products from us. Depends on the size of the company, depends on the stage of the company in their life cycles, and depends on the industry of the company, and depends on the market share of the company, and all these things. So keep that in mind. And when we look at customer profitability, a short period of time, that is valuable, but a long-term profitability is more valuable than solely looking at the short-term availability. All right, profitability, and an increase in overall demand from having reference customers. Okay, so another thing looking at is that Another thing looking at here is that, okay, so probably this customer is not so profitable, right? So let's say it is a break-even customer, and we tried every single way out that we could try, and we're still not able to earn any earn profits from them. Okay, we're not even able to earn a penny from this customer. It's a break-even customer, but we still probably want to keep this customer on our customer list and to send out some welcome or celebration brochures or holiday greeting cards, okay, to them, and to make them satisfied, because they probably have a lot more clients resources than we have, and they can help us to obtain more customers than we can do by our sales teams. Okay, so that in terms of cost of getting those new customers, it's probably going to be benefit us to keep this break-even customers or lost customers. That makes sense? So not only looking at that profitability from that specific clients only, but also we need to consider other factors like their our customers' market reputation and our customers' relationship with their clients or with their competitors, or if they are the leader in a company and they are buying products from you, and because you don't have that stronger negotiation power and you're losing money from these giant companies, but they can set a good example, and everyone in that industry probably going to start following him and to starting buying products from your company, which grant you more profits. That makes sense? All right, and then the last one is ability to learn from customers. Okay, so this customer feedback, which is very, very important. You always want to know which features of your product or which features of your services that make them happy and they buy it more, and which features they don't think is quite useful, and probably going to adjust your products or your functions or some part of your business. All right. So with that being said, all these things, when we look at those profit customers, break-even customers, and lost customers, we want to come up with strategies to increase profits from the profitable customers, and then we want to start to earn profits from the break-even customers, and then we want to implement some strategies to turn the loss into profits from those lost customers. Okay, so that is the general strategies. Okay, and for specifically the lost customers, that is one way, and the other way of dealing with the lost customer is if we tried out everything and it didn't work out, and they don't have a good relationship with their whatever partner is, and they are not really famous in their business, they don't have future at all, then probably this is the type of clients or customers you want to drop off from your client list. Okay, so it doesn't waste the time or resource to keep them in the game. All right, so those are the things you need to talk about, right, or think of when it's come to customer profitability analysis. However, here's the thing: or let's say customer analysis management, this technique really is not a strategy. Okay, it is not a strategy. The information it provided, the information this strategy or management skills provides, is not able to tell us what do we need to do. Okay, what do we need to do? It's not that thing. It is a supportive tools. It is supporting data for us to make future strategies for us to improve profits. Okay, so this is not something that you come up with and then pull out all this information from your information system and then say, hey, this is what we need to follow in the future. No, this is not that type of thing you can have. Okay, so this is the information you have to have up front before you make your decisions, your planning, your strategies for the future. All right. Alright, so fully allocated customer profitability. Okay, so recall that the first purpose of allocation is to provide information for economic decisions such as pricing by measuring the full costs of delivering products to different customers based off on an activity-based costing. Alright, so again, fully cost, since we are using, in general, we are using time-driven activity-based costing. Alright, so it's really, we have something like this. Depends on the level of the cost. We have division cost, the channel cost, and the corporation cost. Again, all these costs are using absorption costing principles. Okay, it's all costs are absorbed into products. Okay, and then it's based off on the different levels, sustaining level costs and division level costs. Okay, those things. All right. Okay, so issues in allocating corporate costs to divisions customers. So here are two questions. When allocating corporate costs to divisions, should a company allocate only corporate costs that vary with division activities or assign fixed costs as well? Or second, when allocating costs to divisions, channels, and customers, how many cost pools should be used? Okay, so this really here is the general answers to those questions, but really it depends on the company. All right, and it depends on the companies. So the types of the company, the nature of the company, the industry of the company, the stage of their business cycle, and the competitive advantage on the market, the market share, and their so on and so forth. These things. Okay, so it's not really a straightforward answer to those questions. It depends on the company. All right. Also, if your company has a lousy management accountants, and you have a lousy CFOs who actually don't know anything about cost accounting or this type of skills, and you are not able to use those things to do anything, and probably going to end up with some inaccurate cost classification information. All right. So it really depends. So then, with all these things said, who actually can use CPMs, customer profitability management? Okay, who actually can benefit from that? Okay, so basically, in general, organizations with heterogeneous products, services, and customers, or there are different requirements in terms of pre-sale or post-sale customer services. Those type of business or organizations can benefit from customer profit management. Simply saying is that if you are going to have different demands from each different customers, and which probably gonna end up with different amount of profits that earned by different customers. Okay, so this is the time when you should implement, or at least you should consider of implementing these techniques into your company, and in terms of making decisions or making up strategies. Right? So who is not really cannot benefit from this thing is if the costs to serve are small. So remember, what are costs to serve? Order processing costs, sustainability, sustaining costs, or customer relationship, those kind of costs, or marketing costs, sales costs. All these things are costs to serve. As long as those costs are not product costs, they are costs to serve. Okay, so if the costs to serve are small, or if they are not changing very much from customer to customer, it really doesn't benefit you that much as those organizations here list on the top. Okay. Or let's say pre-sale or post-sale customer services are not important in gaining a competitive advantage. Okay, it really depends on the service quality that you provide to the customers. For example, Walmart, right? Walmart, they don't really have those thing to distinguish between customers to customers, because they don't provide any pre-sale services or post-sale services. The only thing that I can think of, at least, is just when it's come to returning products, it's much easy, right? So that's the only thing, and that doesn't really vary from customer to customers, right? So this is not really the thing that those companies should use, because really you have benefits Well, because CPM, this information can provide accurate information or more accurate information than other conventional costing systems or accounting informations, then it at least will benefit one way or another and somehow. Okay, but when it comes to implementing something like this, it's not only about benefits but also the cost, right? We need to do cost and benefit analysis. If the cost is so much more than the benefits, it's really not worth the resource or the time and the effort to do such thing. It's so stupid, right? So, but for this type of business, it really worth the time and resource to look at those profitability by customers or by product lines or by customer sections. Okay, so probably you have so many different customers. Okay, let's say you have 1 million customers in your customers list. Okay, you have 1 million customers. You cannot really, or at least it's not realistic to do customer profitability analysis for this 1 million customers. But out of these 1 million customers, you probably can sense out that some of them have some common features. Some of them have common natures and doing some similar business. You can arbitrarily classify them or combine them into a similar or one category, and we call it customer segment. It could be depends on the geographic location of those business. It could depends on their stage of business cycle. If there are startups, you're probably gonna classify them all the startups together, or if there are the giant companies, you're probably gonna classify them together, or if they are international companies, okay, so probably Chinese companies, one category, Africa companies, one category, okay, Canada companies, one category, Germany companies, one category, and all these things. Or age, okay, different age of those of the companies, or using zip code, okay, using zip code. If you're small companies, you're probably gonna segregate the geographic sections more at a more detailed level. Okay, you have different counties. Okay, so those kind of things. All right. So, and all these things we are come up with, or we discussed here, is how to figure out the profitability from each customers, and then we're able to come up with some strategies. And those strategies could be offering more attractive price, or to charge more to those lost customers, or break-even customers, or to sending more attractive brochures and to introduce more products to those profit customers, and so on and so forth. Those things, okay, or your advertisement strategies. Okay, you can probably target your potential clients, customers. Okay, for example, YouTube, Google is using target marketing skills, right? So if you open up your YouTube and you click on a video, and then those ads shows on that page, probably is going to be very different. So for example, like you and your friends is sitting together, and you both on your you on your laptop, and he's on his laptop, and you're signing using your using each one of your YouTube username. Okay, so you never watch those things together. So if you open up the same video title, okay, so probably you're gonna see two different ads. Okay, so your ads probably gonna different from the one that your friend watch, because it depends on your preference, interest, and depends on your hobby, and depends on your behavior on internet. They're targeting as your different customers, different type of customers, and you're gonna see different type of market advertisement. Okay, so based off on this profit analysis, you could do some target marketing and techniques or strategies to improve your profits, so to speak, right? All right. So that thing, with that being said, another thing about those customer profitability analysis is comes to remember first several slides we talk about sales volume difference and price discounting, discount offers difference, right? So that comes to the sales variance. Sales variance. Okay. So remember when we talk about variance, we really comparing actual performance with budgets, right? We have two different budgets. One is static budget, the other one is a flexible budget. Okay, flexible budget. Static budget is everything is based off on a budget. Okay, we have standard, which is per unit budget. That's how much materials we should put in 1 unit of product, how much labor time we should spend on 1 unit of product, how much of machine hours should be spent on 1 unit of product, and multiplied by the number of units we should produce or we should sell, right? So that's both of these factors are budgeted numbers. And then flexible budget is all those standard budgets, the per unit budgets, okay, how much materials we should spend on 1 unit of product times the actual number of units produced times the actual number of units sold, right? So that is flexible budget. And actual information is the actual number of units we've sold and the actual cost to make those products, whatever the actual out-of-pocket cost is, right? So that is the actual performance. And the sales variance here we're looking at is what factors could cause sales indifference than the actual cost, the actual sales indifference than the budgeted sales, right? So here we have two different static budget variance, which is difference between actual results and static budget. Okay, static budget, which is the overall variance. And then down below that, we can separate the static budget into flexible budget variance and sales volume variance. Okay, so flexible budget variance is the difference between an actual result and the flexible budget amount. Don't worry about that. You can think of this variance as a selling price variance. Okay, price variance. You can think of this as price variance, but it's not quite as much, but very similar. Okay, and then the other part of the static budget is sales volume budget. This the variance could caused by the selling price, difference in selling price, or it could caused by the sales volume. Okay, right? I thought I could sell it for $1 per unit, but at the end of the day, I only sell it for 10 cents per unit. That makes sense? And I thought I could sell 1 million units of the product, but at the end of the day, I sold 2 million of products. That makes sense? That is the volume variance. That is the selling price variance. Okay, so sales volume variance also can come down to the third level variance, which is in that sales volume variance could result from sales quantity variance and sales mix variance. What that means is that sales volume is the number of units the customers purchased or some number of units of products you sold to the customers. But we have different customers, and customers buy different type of products from us. Make sense? Coca-Cola have Sprites, have Coca-Cola, and have some orange juices, and all these products, different type of products. One customer could come up to you and say, "Hey, I want to buy 10% of Coca-Cola and 90% of Sprite, which comes with composes 100% of the sales orders," right? So another customer could come in saying, "Hey, I want to buy 50% Coca-Cola and 50% of Sprites." Okay, so that's different mix, and also you can have different quantity, right? Sales quantity. Okay, so quantity makes sense, right? You're supposed to they can change the number of units they purchased. Okay, all right. So this sales quantity variance also can break down to another two level of variance, which these two variance is called level 4 variance. Okay, level 4 variance. Level 1 is the overall variance. Level 2, we break the overall variance into two subcategory, which is flexible budget variance and sales volume budget variance. And level 3 is the variances resulting in the sales volume variance, and the level 4 is the variances in this sales quantity variance. Sales quantity variance depends on the market share variance and the market size variance. And what it's saying here is that market share variance is given the current market condition, is our market share shrinked, or is our market share increased? Okay, so you think you have 90% of market share, but at the end of the day you only have 50% of market share, and that could be changed by different factors, right? Political factors, emergency factors, war, pandemic, right? Those things. And market size also is a different factor. Really, this can be market share variance that could be depended on like our marketing strategies, our market reputations, our company's reputations, and our relationship with customers, and our advantages comparing to our competitors. But market size is relatively micro level of economic factors. Okay, so this about the whole market. Okay, if the market is a new market and the market size is growing, and even though your market share is small, and you're gonna have a positive a favorable variance in terms of market size. Okay, I mean favorable quantity variance at the end of the day. Okay, potentially. And if you are in a business industry that is actually dying, then the market size is shrinking from year to year, right? Even though you have 100% of the market share, but your realizable value is decreasing and decreasing from year to year. That makes sense? All right. So I'm not going to walk you through the math part about this, because it's very much similar to the materials variances, materials quantity variances, materials price variances, and the labor efficiency variances, and those variances. Okay, so here is your the formula. Here's the formula, and you know what F and U stand for, right? F means favorable, U means unfavorable, and you know when the variance is favorable and when it is not favorable, right? If you don't quite understand these things, make sure you post your questions on the discussion forum, and we can discuss that. Okay, and for sure I know some of you know this so well. Okay, make sure you check the discussion board and help me to answer those questions. All right. So this is the formula you follow to calculate those variances, right? And here also is the separate and formulas to help you to see them easily. Okay. All right, and here also additional formulas and concepts. And here is the general picture about these 4 different levels of variances. The overall level of variances break into 2 categories: flexible budget variances and sales volume variances, and this one break into another 2, and then break into another 2. So there are in total 4 levels of variances we're looking at when we talk about the sales variances. Okay, remember when it's in 235, when we talk about those variances analysis, we sort of escaped the revenue variances, right? Revenue variances. Now this section fill in the revenue variances, right? What can cause revenue change in terms of predictions? All right, so this is how we get those variances, and that actually a lot more complicated than we thought of in 235, right? And I forgot to discuss this with you. Okay, flexible budget variances. Flexible budget variances. Where is this? Let me see. Okay, here. So flexible budget variances. Nope. Where is that? Okay, so basically flexible budget variances is what actually change is what actually changed, and these formulas, if you cannot find on this, okay, right here, this flexible budget variances is the difference between this number and this number. Okay, so $22,627,500 and $22,500,000, which is, okay, so these two numbers, and that number is the actual results, the actual units of all units sold times the actual sales mix composition and times actual contribution margin per unit. Remember, contribution margin is selling price minus variable costs per unit, and it's contribution margin. And here, everything, flexible budget, everything is on actual, right? Everything is on actual except the one thing, it is not on actual. And in this case, you have the thing that is on budget. From budget is budgeted contribution margin. We're still going to use actual units sold and actual sales mix, but here we're looking at budgeted contribution margin. Okay, given the actual amount of units we sold, how much profits we should have earned. Okay, so this is what it's saying in terms of flexible budget here. Okay, given the actual amount of units we sold, given the actual sales proportion, okay, variations, and how much profits we should have earned, and comparing to how much we actually earned. All right, how much we actually earned. So that gave us the flexible budget variances, which you can think of as, selling price variances. Really, contribution margin is the result of two factors: selling price and variable cost, which also depends which also on a per unit basis it doesn't change, right? Doesn't change. Okay. All right, so that's it of this chapter, and there are additional slides from the publisher, and I'll let you know the slides that we just covered is not all of them are from the publisher slides. I put in some additional information from Institute of Management Accounting website, which I think is more which I think it's important for you to know. And in terms of this chapter, okay, calculation is not a thing that I concern, and also I don't think you have difficulties in terms of solving those math problems as long as you can follow those equations. But the thing that concerns me a little bit is how we can, if we can quite understand this customer profitability analysis concept and where we can use them. Okay, where we can use them. And my point is that what you need to understand is really the idea of using this type of techniques to come up with strategies and to support decision makings. Okay, so it's not about something that, okay, I know for sure and I can follow the strategies and they will come up with some successful performance. No. And another thing about this thing is that even if it comes to it's about the lost customers, if it comes to the very bad time that you decide you are gonna drop this customer from your customer list, and you need to think all those sunk costs and those unavoidable costs. Okay, so because those costs will not go away even if you drop those customers, right? So you have to reallocate those costs that previously allocated to those lost customers to the other existing customers. Okay, probably will end up with more losses. That makes sense. And another thing is, when it comes to those kind of decision makings, for example, you're dropping your customers in the future, and we are not only looking at those things with just face value. Okay, we need to think about in terms of long terms. Okay, in long term profits and long term effects, so to speak. We need to take into the factor like net present value and internal accounting returns and cash flow. It's not about 1 year cash flow or 2 year cash flow. It's about that customers overall cash flows. Okay, so what is overall cash flow for a specific customer is assuming you have an idea how long they're gonna keep the business with you, and then in terms of that long time, how much cash flows you can generate from this specific customers, and then convert that into present value and do that net present value analysis, or calculate your internal rate of return. So it's kind of like decision making for a project, keep or drop, add or not. So buy or sell, buy or make, those kind of decisions. Okay, so still we need to consider those financial factors, not only just those face values. All right, so this actually is a lot, not a lot, it's quite complicated concepts, and we don't want to extend on this topic. So this we can have, in this chapter, we just talk about the general idea of how to use that. So when it's come to this, the case for this week, I really want you to think outside of the box, use this idea, use this concept, and to make some strategies. Okay, not only about accounting strategies. Really, using this information, you don't have any strategies you can make in terms of accounting. All right, so it's really a supportive information. You have to rely on this information when you come to make decisions, but this is not something you can use directly in terms of implementing strategies. You have to make up your own strategies. That makes sense? You cannot use this as your strategy. Tell me that this is profitable and we're gonna drop those lost customers, and then something like this. No, it's not gonna work that way. All right, you have to work. For example, discuss with your classmates, or Google it on on internet, or read more chapters, or read more textbooks, or some articles on this thing, and also go back to review your marketing courses and management courses, whatever you can think of. Okay, it's gonna be an open-ended question about when it comes to this week case discussion. Okay, so I'm looking forward to the discussion, and I hope you guys can really enjoy this technique, and then to discuss your ideas on this topic. All right, so if you have any questions, please shoot me an email, or otherwise put on the discussion forum, and I'll see you next week. Bye.